Welcome, everybody, to the 2025 Market Outlook program. We are happy to host our program for Tower Trust and Investment Company. For those of us that don't know Keith and I have with me Keith Bonjour, our portfolio manager, senior vice president, and my name is Cody Allen. I'm president of Tower Trust and Investment Company. We are excited to announce our new company. For those of you that weren't aware, we transitioned over to our new name effective 1/1 of this year. And the new name again is Tower Trust and Investment Company. We have been Northwest Bank and Trust Company's investment management department since 1969, and we're honored to talk about the transition. So if you have any questions or thoughts and want to discuss that, please let us know, and we'd be happy to go over that with you. But today's program is a look in the windshield, and we'll spend a little time in the rearview mirror, but we will be spending some time in the windshield to say what does this look like? What do we have for economic and market news in 2025 that's going to drive the financial markets, and how are we preparing our portfolios to have a game plan that stands the test of time throughout this year? So I'm going to hand it off to Keith, and as we go along, I'm going to have probably some commentary we'll add along the way. But other than that, without further ado, I'll hand it off to Keith.
Sounds great. Thanks, Cody. And I'll start off. We'll talk about one of the biggest elephants in the room is the tariff situation that we're dealing with right now. So the first couple slides, we'll talk about what's been proposed so far and the effects that it may have on the economy and inflation this year. So starting out, as we look at tariffs, President Trump proposed a 25% tariff rate on Canada and Mexico. Each of those have now been postponed for 30 days. And there was also a 10% tariff on China that has now taken effect. The goals of that was said to stop illegal immigration, poisonous fentanyl from crossing the borders, and other illegal drugs that have been flown into our country, as well as to improve bilateral trade deficits with these countries. So as of right now, tariffs are on hold with Canada and Mexico. There's been some agreements that they've come to on that. So we should have a pause, and that may be suspended for good. So the U.S., though, is relatively self-sufficient on the economy. We only import about 14% of the total GDP as of the end of year of 2023. However, when we look at those imports, out of that, 43% of those imports come from either China, Mexico, or Canada. And Mexico actually overtook China back in 2018 as our leading trade partner. There was also energy tariffs that were going to be put on Canada. Those were reduced to 10% since many U.S. refineries, especially in the Midwest, are only processed the shale that we produce in the U.S. Those refineries are not set up to do that. So we import a lot from Canada. Therefore, on those tariffs, it was reduced 10%. So it didn't have as big of an impact. But as of right now, those are all on hold for the first 30 days. And we'll see if they come to an agreement and that sticks going forward. So on the next slide, we'll talk about tariffs. Are they a negotiating tool, or is that going to be the new normal during the Trump presidency? And if we look back at Trump's first presidency, tariffs overall became more of a negotiating tool rather than a shift in economic policy. So they were set up to bring other countries to the table in a much faster manner, to speed up negotiations and try to get a better deal for the U.S. On some trade deficits that we were running with the rest of the world. We think that's going to be the case this time, as we've already seen with both Canada and Mexico, that agreements were implemented very quickly before those tariffs took effect. So we do expect that to be more of a continuation this time. We think China will continue to have more of the brunt of tariffs, but the European Union is next to be discussing about some of our trade imbalances and some of the protection that they have for their goods that is not reflected when U.S. goods come over to their shores. So there's definitely going to be some negotiations with Europe and some other Asian countries as well. And the one thing that we worry about this is the higher the tariff rates are, there's this worry about a tit for tat, that if the U.S. puts tariffs on other countries, those countries will retaliate. And then that can increase the cost of goods. But what we saw in the first Trump administration is a lot of the goods that were produced in China, they started to move to other Asian countries that didn't have tariffs. So it wasn't a dramatic move, but we did import less from China and more from other countries. And Mexico was a big beneficiary of that as well. And the higher the tariff rate are, the more incentive that companies have to move their factories outside of China to other countries that still have low wages in order to avoid those tariffs. I know there's been some talk about moving more manufacturing onshore to the US, and that may still happen to a certain extent, but the cost of wages are much higher in the US. And then if other countries put on retaliatory tariffs, the cost of goods being exported from the US would be more expensive as well. So we'll be watching to see how that shift plays out. But we think it's going to be more movement out of China to other countries in Asia, also, Mexico and India and some other large economies that benefit from that. So on the next slide, as we talk about what effects would the tariffs have upon implementation, there's been a lot of talk in the industry that if we did get into a more prolonged tariff or trade war scenario out there, that there's some retaliation to what the U.S. imposes on other countries. It could be a hit of up to 1% of U.S. GDP growth, is what the studies have said so far. And again, that is going to be if it is more of a prolonged tit for tat retaliatory tariff situation, which at this point doesn't appear to be the base case. We think that's a lesser probability. So if the tariffs were more selective, we think it would hit growth slightly in the U.S., but not enough to derail positive economic growth for this year. Both China and the U.S. are unlikely to see a recession due to tariffs because the underlying strength of the economies overall. But Mexico and Canada are more vulnerable. If we did get into a larger trade war with Mexico and Canada and those 25% tariffs were actually enacted, that would be a much bigger hit to both the Mexican and the Canadian economies that could cause recessions in both countries. So they definitely have a lot of motivation to come to an agreement and not have the higher tariff rate on their goods. So we do think the U.S. can still sustain its economic growth, though. The U.S. still looks good for this year, even if the tariffs, are more selective and does hurt growth a little bit. It shouldn't be enough to see a recession in the U.S., and we should still see positive growth for the year overall.
Keith, we should probably give a little bit of an explanation here just for a moment to say that we're recording this in February of 2025, and the data is as good as 2025, February 2025 gives us.
Yes, absolutely.
If folks are watching this later in the year, it might be different.
Yep. So yeah, that's absolutely a good point, Cody. So this is as of February of 2025 of what we know on tariffs so far. So again, those have been pretty fluid. They've been changing weekly, so we'll see how things play out. But this is the base case scenario as of what we know currently. That's a good point. The next slide, it talks about what is the Trump administration, what are their policy goals? So right now, they've talked a lot about deregulation and tariffs and taxes overall. So these are not standalone goals. The Trump administration is really trying to tie all three of these goals together in order to, one, reduce the U.S. deficit, to decrease regulation so that hopefully companies are able to produce more and have higher profits, therefore paying higher tax rates to help pay down the U.S. debt. And then using tariffs as a policy tool to negotiate better deals for the U.S. overall on the global economic scale, and help to increase GDP, which then is going to drive more tax revenue as well. So that's what the Trump administration has said that their policy goals are. And we're just watching of how that all is implemented this year and how that plays out, how it's going to affect not only increases in taxes, but deregulation, hoping to increase economic growth, and then the tariff revenue coming in to hopefully pay down the debt and level out the playing field for some U.S. companies that are operating on the global stage to make the cost of our goods a better deal for international consumers to purchase as well. So that's the main policy goals. We're going to continue to watch how they play out throughout the year. But understanding the process overall, that's the Trump administration goal of working on all these three items in tangent to try to improve the overall economic growth this year and for future years. On the next slide, though, looking back at when tariffs were implemented back in 2018, what effect did they have on other countries and China especially? So if we look at the left-hand side of this chart, the average tariff rate on U.S. good imports from China right now stands just below 11%. That was as of the end of 2024, prior to the additional 10% tariff rate being imposed on China. So China is going to see cost of goods increase for U.S. consumers for sure if we are importing more from China. And on the right-hand side, what you'll see is a chart of different goods imports by country to the U.S. as of 2024, going all the way back to 2000. What you see in 2018, after the start of Trade War 1.0, you'll see the goods coming in from China decrease substantially. We went from about 22% of our total U.S. good imports all the way down to about 15% goods coming from China as of last year. So those goods have moved to other countries. You'll see both the Eurozone area, Mexico, other Asian countries, Taiwan and South Korea, as well as India, have all increased their exports to the U.S., where China has decreased exports. So the U.S. has basically seen supply chain shift and move those goods to other countries that are not affected by the tariffs to benefit economic growth in those other countries at the expense of the Chinese economy. We do think this will continue with the additional tariffs that have been implemented. We think the U.S. will continue to look for other trading partners to diversify their supply chain and not be so reliant on China, especially if the Chinese goods imports are going to continue to increase in cost. So we think it'll be more of a repeat of what we saw in 2018 to see other countries pick up their trade with the U.S. At the expense of what we're importing from China. And then on the next slide, talking about how each party or breakdown of Congress has impacted the stock market over time. What you'll see is on the left-hand side, the dark blue ones are when we've had a divided government, whether it be a Democratic or Republican president, and then the House has been divided. Historically, we've seen pretty strong returns overall when we've had a divided government. The top three returns are all during a divided government. You'll see on the left-hand side of the slide. So anywhere from 13% a year for the S&P 500 to as high as 15%, almost 16% a year during that split. However, the fourth best is when we've had Republican control of both the president and Congress. It's averaged very close to 12.9%, which is right in line with those other breakdowns. And then you'll see the other one in the middle when we had full Democratic control. The S&P actually averaged a 9% return in that environment as well, going all the way back to 1933. And that even includes the Great Depression. So the 8 years where the market really struggled. And that's why that 9% return is lower than a lot of the other ones, because of the Great Depression numbers being included in there. So at the end of the day, we look at the breakup of Congress and who's in presidency, but it normally doesn't have a big effect on the overall economic growth in the stock market in general. So we pay attention to these trends, but as you can see historically, it doesn't have a big impact on total returns for the market. And the next slide here actually shows that in a different breakdown. It goes all the way back to 1956. And the light blue is if a Republican president was in control. The dark blue is if we had a Democratic president. But what you'll see historically over time is the market has done well in spite of who was in office. You'll see a continuing upward trajectory all the way back from 1956 to the present, that almost every single presidency, we had a nice return over that period of time. The only time it was actually negative was when George W. Bush was in office there. We saw a negative 21% rate of return. And that was from 2000 to 2008. We actually saw two recessions in an 8-year span. We had the tech bubble, followed by 9/11 in the early 2000s, and then the 2008 recession at the end of his presidency. So that was the only time going back to 1956 that a full presidency was actually negative for the market. Every other time, the market has been positive. And that just happened to be the worst decade in stock market history as well. So just goes to show that the longer you're invested in the market, the higher chances of positive returns. And who's in office traditionally doesn't have a big impact on the overall S&P 500 returns over that period of time.
If you were to ask me the top two topics that we have, and tell me if you disagree or not, Keith, but I think the top two topics that we've had in our review meetings with clients thus far this year has been one, what's the what if game of the tariffs, and this is our way of digesting that information based off of our research, and then two, what's the overall the overarching goals and expectations that we should expect out of the markets based off of the outcome of the election, and the first series of slides I think does a nice job summarizing that.
Absolutely. Yep. And there's still a lot of unknowns with the tariffs, but overall, if it looks more like how the tariffs were implemented in 2018, the market got a little volatile that first year of digesting that, but the remaining years of Trump's presidency, the market did very well over that period of time. So still a little bit of unknowns, but overall, if it is a more watered down version of the tariffs that are eventually fully implemented, that shouldn't have as big of economic growth, and the stock market can still do well in that environment.
Right. As we think about the next topics that we come in touch with our clients, I think the next topic we have on the next slide is the U.S. national debt, and that has absolutely been a conversation that's been in both the research that we've been receiving as well as the conversations with the clients. And I think these next handful of slides do a nice job of giving us a little perspective of, so what exactly does the national debt mean, and where do we go from here?
Absolutely. Yeah. And we've seen the U.S. national debt continue to trickle higher. A big spike happened after the 2008-09 recession, and then again during COVID. So we've seen a big increase in U.S. debt overall. If we take a look at the first slide, you'll see the U.S. government is spending right now around $7 trillion a year between Medicaid, non-defense spending, defense spending. Net interest on our debt is just over $1 trillion, which makes up about 15% of the annual spending. So that number is really starting to be a larger and larger number as our debt increases. And then the biggest culprits are Medicare and Social Security combined make up almost 40% of our annual spending as a U.S. government. And our sources of funding, you'll see we only have around $5 trillion of funding coming in from payroll taxes, corporate taxes, and income taxes overall. So we're running a budget deficit of roughly $2 trillion on an annual basis for this year. So it's something that right now the Trump administration is really focusing on, trying to determine, what areas can be cut and how do we work on continuing to write that budget and not continue to run these $2 trillion deficits year after year, which is really putting some strain on the net interest payments that the U.S. government has to make, and how much money is coming in versus what's paid out just to cover that interest. So a lot of what you'll see in the news recently of Elon Musk coming in and the Department of Government Efficiency and what they're trying to do to reduce the costs all across government in order to save some of that funding deficit and right the ship, if you will. It's too early to say how effective they'll be. I think a full $2 trillion cut is a really, really tough projection to hit, given where some of the required spending is for the U.S. government. But again, any cutbacks across the board to reduce that deficit, if they do find some more efficiencies, that's just going to be less interest payments that the U.S. government has to make on an annual basis, which in turn will help pay down that debt faster. So we're continuing to watch that closely of how that comes out. But we do see that America does have a debt problem. We are running a deficit of roughly $2 trillion a year. That does have to be reined in at some point, or it's going to be more and more of the annual income of the U.S. government that's coming in, just going out to pay the interest on that debt. The next slide here gives a little bit of a breakdown of where those payments are coming in as well. So you can see on the left-hand side, we have that total spending of $7 trillion, a breakdown of where that's coming from. And then the total deficit that we're running is right about 28%, or almost $2 trillion on an annual basis. Now, there's been some talk on the slides in the bottom right about extending the Tax Cuts and Jobs Act, which was passed during the first Trump administration, that reduced the federal income tax rates across the board for U.S. filers. So the 15% bracket was reduced to the 12%, the 25% bracket was reduced down to 22%, and so on up the income spectrum. That was set to expire at the end of this year, but the Trump administration has made it a priority that they want to see that extended. What you'll see will add about 10% more deficit to the U.S. GDP, how much more we're spending than we're bringing in by 2034. So they're going to need to be looking for ways to offset that debt and come to an agreement so it won't continue to add to the net debt of the U.S. government. So there'll be more to come from that, but that's why they're really looking for ways to be more efficient and to cut government debt is in order to be able to extend those tax cuts so that the average U.S. citizen continues to pay the lower federal rates and we don't all see an increase in our federal taxes starting 1/1 of 2026. On the next slide, we'll talk about, though, is the U.S. government. We have a big negative cash flow, as we just talked about, a $2 trillion annual deficit. However, when we're talking about liabilities, this chart shows liabilities of around 34 trillion. Today's dollars, it's actually closer to 37 trillion now. But the U.S. government overall actually has well over 200 trillion in assets. So we are, I'll say, cash flow negative. The money that we have coming in every month versus what's going out, we're running a deficit. But when we look at the net worth of the U.S. government, we do have considerably more assets than what we have in liabilities. So if the U.S. government was going to the bank to get a loan, because we have well over $200 trillion in assets and roughly 37 trillion in liabilities, the U.S. government is still a good borrowing risk at that point. So, and it gives a breakdown here nicely of where all the U.S. assets come into play between oil, natural gas, coal, all of our military assets, the government buildings, all the land that the government owns, and our gold and stock and bond holdings in there. So you'll see overall, the U.S. government is still in a pretty strong position based on their assets and their net worth. We just are upside down right now and how much we're spending versus what we're bringing in. So that will have to be addressed. But as long as our assets are considerably higher than what our liabilities are, the U.S. government is still a good credit risk if they were going to the bank for a loan these days.
Yep, agree. As we think about transitioning to another topic, another one that seems to be a popular part of our conversations has been, where will the Fed go? What is the Federal Reserve going to do for us, and what is it going to look like going forward into 2025? And I think that continues to be a moving target based off of the reports that we've seen, whether it be the CPI report, the PPI, or the unemployment rates that have come out to determine kind of where we're going to land. But I think the Fed seems like they've been doing their job. For the last couple of years, we've taken the inflation rate down by it was over 9.1%. Now we're looking at a better situation today. But now the question is, can we get back to that long-term average? And I think that's a question that a lot of our clients have been asking as well.
Absolutely. Yep. And the Fed's got a very difficult job right now, coming from over 9% inflation down to 4% or below. Much easier to make that move as things start to cool off, and year over year those numbers are coming down. Now that inflation, depending on the report that you're looking at, is anywhere from 2.8 to 3.1%, the job gets more difficult to get it down from around 3% all the way back down to 2%. So some of the easy moving targets are passed, and now the more difficult job comes. So the Fed currently sitting at a rate between 4.25% and 4.5%. As we move forward this year, the Fed, as of September and October of last year, they were talking about cutting rates 4 times in 2025. As the end of the year progressed and early this year so far, their projections have come all the way down to only about 1 rate cut sometime late summer or early fall this year. And a lot of that has to do with the unpredictability of how tariffs will affect the economy. If we see the cost of goods going up due to tariffs, that can weigh on those inflation numbers. And the Fed's indicated they just want to be more patient and hold pat for a while this year to see how all that plays out. So what you'll see is we saw the big spike in inflation during 2021 into 2022. Things finally bottomed or topped out towards the end of 2023. And then we've been in a slow and steady decline since then. But now that things are breaking below 3%, getting all the way back to 2% is going to be more and more difficult when a lot of the current inflation is due to shelter cost, housing costs continuing to be more expensive, less homes on the market, meaning people are paying more for the cost of homes. We've seen insurance rates be extremely expensive due to all the natural disasters. That's hit both home insurance, that's hit car insurance. So those have continued to be, big numbers in the overall inflation reports as well. So it hasn't had just to do with the economy itself. It's some of the natural disasters that we've seen out there with the floods and the fires that is also continuing to weigh on inflation as well. We do expect those things to continue to cool off over the next few years, as long as the tariff implementation does not come in at a high rate, and we see other countries really, retaliating to that at a high rate. That's what could cause inflation to start going back up again. If that happened, that means the Fed wouldn't cut rates any further. They could even be forced to raise rates in the future if inflation really started going the other way. We think it's too soon to indicate that we're worried about inflation going back up again, but we do think this year it is going to be a little bit stickier than what the Fed expected towards the end of last year. So on the next slide here, you'll see the dot plot of the Fed's expectations. And as of September 2024, in the light green dotted line, the Fed was expecting to cut rates several times in 2025, about 4 cuts, with an additional cut or two in 2026 before getting to what they considered a neutral rate and holding pat there. Now, as of 1/31 of 2025, you'll see the light green line at the top. They're projecting less cuts in 2025, only 1, maybe 2 cuts this year, followed by a holding pat with maybe 1 more in 2026, and even a possible increase in 2027. So all that's saying is that the Fed is being more cautious. They're in a wait and see mode right now to see if impending tariffs are going to weigh on inflation. And if we do start to see the cost of goods go up, they will be more patient and decide not to cut rates and give the economy more time to deal with those inflation numbers and hopefully bring things back down again. But the Fed's not going to be in a hurry to cut rates if they see inflation being stickier this year.
One of the things that we've talked about here is so goes the U.S. economy, as goes the consumer. And the things that we've talked about thus far in the program, we've talked about the idea of tariffs, we've talked about the idea of what is the inflation rates going to be, and all this buys into the consumer. And we've seen a consumer that's proven to be pretty darn resilient. But the question is, where do we go from here? Do we have a consumer that continues to spend, or do we see that consumer start to pull back? And the following slides are going to be talking a little bit about the idea of, so what does the numbers tell us at this point in time?
Absolutely. Yep. So the first slide, just joking about the pennies going away these days. So that is one cost savings that they're saying it costs about 3 cents to make each penny. So are they going to just do away with that entirely as we go forward? So looking at the economy and the consumer this year on the next slide, you'll see a breakdown of some strong economic growth in the past. So one of those is represented by kind of a teal line from 1965 to 1969. It was when we saw a span of time in the U.S. that the unemployment rate remained very low, at 4% or below. And we also saw strong economic growth over that period of time. The same thing happened in the mid to late 2000s, where we saw strong economic growth and a low unemployment rate. Both of those periods of time proved to be very strong for the stock market overall. The stock market did quite well over those periods. And where we stand today in economic growth are very similar to that. We continue to have strong GDP growth overall in the U.S., and we continue to have very low unemployment rates. So that's something we watch as we go forward. But at this point, the U.S. economy is in a very strong economic backdrop because unemployment is low. The cost of living has come down with inflation. However, the raises that individuals were given throughout COVID and the higher inflationary environment, the average consumer has a little bit more spending power today than what they did, pre-COVID. So as long as unemployment rate continues to hover at low levels, that should continue to help consumer spending, which is driving the economy. At the end of the day, the U.S. consumer drives almost 70% of the U.S. economy. So as long as we continue to have strong consumer spending, that should play well for economic growth and the stock market overall. What we'll see on the next slide here is, if you look at the average consumer balance sheets in the U.S. right now, On the left-hand side, you'll see the total assets held by the U.S. consumer as of the end of the third quarter last year. We had almost 190 trillion in assets. You'll see 28% of that number was made up in home values. We've got some deposits, checking and savings. We got the pension funds in there. And then we have other financial assets, such as stocks and bonds and overall investments in retirement plans. And then the chart right next to that on the bar graph there, you'll see overall liabilities of the U.S. consumer. And our liabilities are a little less than 21 trillion. So right now we've got a consumer balance sheet of almost 190 trillion, and we've got liabilities of just under 21 trillion. So the average U.S. household is in very strong financial shape right now, again, of overall net worth and the ability to continue spending. So if we look at the upper right-hand chart, households, their ability to service their debt continues to be very low. As of the fourth quarter of last year, debt payments as a percent of their disposable income was at about 11.3%. And if we look historically going all the way back to 1980, that continues to be a very low level overall for the U.S. consumer. It's not quite as low as it was back during the early days of COVID when all the stimulus payments were going out and we were all stuck at home not spending any money. But now it's come back up, but it's still at a very low level. So overall households, their ability to service their debt remains in a very strong position. On the bottom chart that we'll see is where are things broken down based on delinquencies between auto loans, credit cards, student loans, and mortgages. And what you'll see is student loans and mortgages are still at historically low default rates or delinquencies at this point. We have seen credit card debt and auto loan delinquencies pick up a little bit. A lot of this has to do with people paying up for very expensive vehicles when it was tough to get. With the average consumer, a lot of them having $1,000 a month car payments, that is a little bit harder for them to service over time. But if we look historically, going back to 2003, these numbers are still at average or below average levels. So at this point, the health of the U.S. consumer is still very strong. A lot of their biggest debt being in mortgages and student loans, and that servicing is still at very, very strong levels at this point and very low delinquency rates. So we feel that overall that the U.S. consumer continues to be in very strong shape, which should support consumer spending going forward. And again, oil prices have been very low as well. We continue to think that oil will average at $80 or below a barrel, which means spending less at the pump and spending more at retail stores and restaurants and traveling, and all of these things help to stimulate the economy overall. So we do expect that to continue. It's going to take something bigger to knock the U.S. consumer off course, and really we'd have to see layoffs pick up dramatically, and inflation really go back up the other way in order to see consumers really start to tighten the belt and stop that spending. And as of right now, we're seeing a very strong consumer.
Indeed. Before we transition into the final portion of our slides, one of the things that we try to focus on is that we're an institution that has a philosophy that we're certainly long-term investors, and we want to set up portfolios for our clients that are meant to stand the test of time and hit the risk tolerances those individuals wish to accomplish and need to accomplish for, more often than not, their retirement savings. We have a little slide here that's next that gives a quick quote from Mr. Buffett, and Warren's always good for a little tongue-in-cheek comment about the simplicity of investing in the markets and what do we need to think about going forward. But I do like the slides that we have coming up that talk a little bit of perspective on the idea of so what exactly is going on in the markets right now from a stock market perspective, and what is the perspective that we need to keep as investors as we go forward into 2025 and beyond.
Absolutely. So yes, the Warren Buffett slide, just talking about transferring money from the impatient to the patient is the device that the stock market is. So meaning the longer you're invested in the market, the higher your probability is of making money. If you're trying to jump in and jump out, a lot of times you're going to get burned that way. And long-term investors are going to benefit from you buying and selling at the wrong time, trying to time the market. So the next slide, this was an interesting look at the S&P 500 over the years, going all the way back to 1990. But what you'll see last year and so far this year is that we're seeing the percentage of stocks in the S&P 500 is a very low level of the stocks that are actually outperforming um, the overall S&P 500. So right now, only about 25 to 27% of the stocks inside of the S&P 500, which is the top 500 U.S. stocks, are actually outperforming the overall index. You can see historically that's a very low level. And the reason that we're seeing that is a lot of technology stocks are doing very, very well. They're outpacing the overall market. And they're making up a bigger and bigger percentage of the overall S&P 500 as their returns have continued to be larger over the years. So this just gives us a little bit of pause of saying we don't want to get too far over our skis, get too heavily invested in technology, because what you'll see historically when this has happened in the past, normally within a couple years, things start to move the other way. And the rest of the names in the S&P 500, their returns start to pick up versus the performers that have been performing best for a few years there. So while we're not saying that we're going to see a big pullback in technology going forward, we do think a lot of the rest of the market is trading at cheaper levels that has a decent probability of picking up their pace and their overall returns versus those top performing stocks. It's just interesting to look at as we've gotten here historically where, back in the late 90s or early 2000s, we had a very similar thing where technology shares had made up a very large part of the overall returns. And we know how that ended up with big pullbacks in those names and more of the value stocks, over the next 8 years or so, outperforming technology and being a safer place to be. So we continue to recommend staying very well diversified in the portfolio and not taking any big sector bets, just not knowing how that'll play out over the next few years. The next slide here, it does talk about, the market continues to hit all-time highs over the last few years. So that's something that we have to be mindful of. But on the left-hand side, if we take a look at that, what you'll see is in 2024, the S&P 500 made 57 new all-time highs throughout the year. So the percent of days that the S&P closed at an all-time high was 6.7% of trading days last year. And then the percent of all-time highs that acted as the market floor, so being the lowest that the market hit after that all-time high and not testing that again, was almost a third of the time. So historically, just because the market is hitting all-time highs doesn't mean that's a bad time to buy. Actually, looking at the right-hand side chart, if we go all the way back to the beginning of 1988, all the way through the end of last year, if we take a look at those buys on a short-term versus a long-term basis, you'll see on a normal gray area investing at any one day on those gray bars, over the 3-month period, you'd average around 3%. Over 6 months, you'd average about 6%. And on any 1 year, forward returns averaging about 12.4%, and even better over the long term. However, over that period of time, if you were actually to invest at a new high and stay invested those forward returns over time, once you got to 6 months out, those forward returns were actually better investing at the new high rather than just picking any day average over that period of time. And that continued on the 1 year, 2 year, 3 year, and 5 year returns. Seeing the 1 year average was actually 13.4% per year, investing at a new high. So again, the market should continue to hit new highs over time. Sometimes it will go through sell-offs and take some time to recover, but over a period of time, the market should be hitting all new highs over that period of time in order for investors to be compensated for that risk over the years. So investing at a new all-time high doesn't spook us. We do think over time, you'll continue to be rewarded for being invested in the market and not trying to time it. So on the next slide that we get to here, it just talks a little bit about that volatility that we expect out of both the stock market, the bond market, and a 60-40 portfolio that would be 60% in stocks and 40% in bonds. What you'll see is on the 1 year number, any 12-month number, we'll be looking at a lot of volatility. So the best 12-month number for stocks, going all the way back to 1950, was 52% for the S&P 500. The worst year was back in 2008. The market was down 37%. The best year for bonds were up 33% 1 year. We just saw the worst year back in 2022 when bonds were down 13%. If you were in a 60% stock, 40% bond type of portfolio, you'll see the best case, worst case in any one year of a 34% upside and a 20% downside. But the important part here is as you look out, if we look at the 5-year rolling numbers, those numbers come down substantially. You've got on stocks averaging the best of a 29% a year over a 5-year. The worst is a negative 2% a year over that 5-year. Bonds at 18% per year over 5 years for the best, negative 2% per year for the worst. And if you were in a 60-40 type of portfolio, they didn't have a negative year over 5 years going back to 1950. And those numbers even get condensed more as we go out 10 and 20 years. And what this shows is the longer you're invested, the higher the probability is that you're going to make money. So we'll see more volatility on any 1-year span, but as you start to look out 3 years, 5 years, 10 years, the probabilities get higher and higher that the portfolio will be doing well over that period of time.
That slide always does a great job. We've had this slide in presentations in years past, and this slide really does a nice job of driving home the point that we can't get sparked by market news. I think there's a lot of times where we'll hear that the stock market's pulled back by X% or it had a rough day or what have you. And I think for most investors, whether they invest with us or other institutions, aren't solely based in the stock market. And looking at a 60-40 split, we have an awful lot of our clients that have hit their retirement years or soon to be retirement years that follow this strategy. And this is a great example of if we stay the course and stay consistent, we're rewarded for it as time goes along. And it doesn't have to be a 20-year wait. The reward happens, in timeframes of 5 to 10 years rather than rolling out decades.
Absolutely. Absolutely. So you can see the short term, 6 to 12 months, we'll see a lot more volatility, but the longer you move that scale out to measure returns, things get a lot more consistent as time goes by, which is why we always recommend staying the course and not making any emotional decisions based on the investments. Because normally when people want to make emotional decisions, that's when the market is down. And that's the worst time to lock in losses and, move to cash or move more conservative, because when that rebound comes, then you're going to be missing out on the upside, knowing that those longer term returns on a 3, 5, 10-year span are traditionally going to average out to more in the median type of returns and have positive returns over that period of time. So the next slide I'll jump into here talks about previous bull markets. So right now, as the middle of October of 2024, the S&P 500 hit a 2-year bull market trend, which means the market bottomed out in October of 2022 after the big sell-off. And we've seen a nice significant rebound since then for the last little over 2 years now. And this chart is actually measuring previous bull markets over the last 50 years that have lasted at least 2 years. What you're going to see here is if they've lasted 2 years or more, the shortest one we've had is 2 separate ones that lasted about 5 years. From August of 1982 to August of 1987, the market did about 225% return over that 5-year stretch. If we look at another one from October of 2002 to October of 2007, again, you had a 5-year expansion where the market was up over 100% over that period of time. And then the other 3 have all been significantly longer, about 6 years all the way out to about 12 and a half years. And we've seen significant market gains in those other 3 bull markets as well, even more so than the 5-year bulls. So what this is saying is over time, bull markets have been lasting longer. Growth has been a little bit slower in the U.S. GDP, but that's basically meant a longer bull market cycle, a longer economic expansion, and the stock market has done very well over those periods of time. So it's too early to say how long this current bull market would last, but wanted to look at the other 5 bull markets that we've seen over the last 50 years that had lasted at least 2 years. And you'll get a little bit of a flavor of the averages and what they've done over time. So hopefully we're in some continuation with at least another 5-year bull market run here, matching up to history and historical norms of what we've seen over the last 50 years in the market. So we still feel like the setup is still very strong in the economy. And again, as we talked about with the consumer, that can continue to push the market forward. Not that we won't see corrections over time. On an average basis, we should see every 9 to 12 months a correction of 10 to 15% of the market. That's very normal and healthy, but it's nothing to be spooked by. They normally don't last very long before the upward trajectory returns in the stock market. And you'll see a little bit of that in the next slide that we move to here. This is going all the way back to 1980, and it shows the returns in the market year by year in the gray bars. And then the red dots are actually the intra-year drops. So how much did the stock market fall during those years in a pullback? And what you'll see here is that returns were actually positive in the S&P 500 in 34 out of the last 45 years through last year, which amounts to about 76% of the time that the stock market had a positive return year. However, if we looked at the pullbacks along the way, the stock market also averaged an average of 14.1% pullback if we looked at all those years together. So sell-offs in the market throughout the year is very normal. Just because we go through a pullback that year doesn't mean that the market's actually going to end negative. So we just have to keep that in mind that historically market pullbacks turn into good buying opportunities. In those, we're looking at our clients' portfolios and we're actually looking to add a little bit of risk when the markets are in a pullback. So we would reduce the cash positions, reduce bonds a little bit. We would actually increase equities during those pullbacks, knowing that traditionally those pullbacks don't last very long. And a year after that, you've got a pretty high probability of making money on those buys. So those are actually opportunities over time to add a little bit more risk to the portfolio. And when I say that, I'm talking tilts of 3 to 5%, not betting the farm by any means. So this is a great chart just to show stock market volatility over time. But again, staying invested, investing for the long term, over the last 45 years, you'd be positive in the market 76% of the time.
That slide's one of my favorite slides to drive home that point of what an advisor can do for you. The idea the advisor is going to be able to add that alpha by putting money to work during those pullbacks that you see, the intra-year pullbacks. And there's no better slide than this one to be able to drive that point home. So I like it.
Absolutely. Yep. And during those pullbacks, that's normally the time that the average human emotion is to be concerned and to want to do something, to want to go to cash or want to move more conservative. And really more often than not, the right answer is that's a perfect buying opportunity that we should be actually adding to a risk over that period of time. And all that's going to do buying in at those lows is going to improve forward returns over the next 3 to 5 years as the market recovers. You're going to make a lot more money by adding on some risk during those pullbacks rather than moving to cash or moving more conservative. And that's our job, to take the emotion out of it in the portfolios and to make those decisions for our clients in order to keep them invested and let them see strong returns over the long run throughout their accumulation and retirement years.
Well said. Well said. All right. Well, we've gone over a handful of different topics. Why don't we summarize the key takeaway for folks?
Yeah, absolutely. So as we go through the rest of this year, with some uncertainty in tariffs and inflation, we do expect more volatility throughout the year. Again, not knowing how impactful tariffs and the effects on both inflation and economic growth will be this year. We do expect that there is going to be a lot of negotiations around that, and the initial proposals probably will not be the ones that are fully implemented. So we do expect a lower tariff situation over there. And again, that being used as a negotiating tactic overall, but adding some more volatility throughout the year as those discussions are happening to both the stock and the bond market. But however, the U.S. economy, the U.S. consumer are both very strong right now. We do expect economic growth to slow down a little bit this year, but should be still around 2% or so growth, which is strong for the U.S. economy. And consumers continue to spend and be in very good shape. We expect that to continue this year and continue to drive the market forward. We are watching very closely, though, inflation and the Fed policy. If tariffs and inflation, do continue to go up throughout the year, it's going to cause the Fed just to be more patient and not cut rates as much as expected or at all. And what that means is that bond returns for the year in that environment will probably be a little bit more lackluster. Overall yields in our bond portfolio are still in the high 4s to low 5%. So we do expect to still continue to clip coupons off of those bonds, still get a nice income of 4.5% to 5% on average, which is still a pretty good rate of return for bonds overall. It just means that there's probably less upside for bonds appreciating if the Federal Reserve holds pat and isn't able to cut rates any further this year. So something we continue to watch, especially in how that'll impact the bond market this year. And also the stock market has been very resilient. We've seen that strong consumer spending, flow through to stronger company earnings, and that's continued to push stock prices higher, especially large cap stocks in the U.S. But that's going to be needed. We're going to continue to need a strong consumer spending out there in order to justify, higher valuations for U.S. stocks and those large company earnings to continue. We're already seeing this quarter reported from what happened last quarter, and U.S. earnings continue to be strong. They continue to outpace expectations. So if that continues, that should still bode well for the stock market overall. We'll continue for all of our clients to rebalance the portfolios. We just spent some time in December of taking some profits off the table in some areas that ran very heavily, adding to some other areas that looked a little bit more attractive overall. So pulling back on some technology names, adding a little bit more to, filling up the safer bond part of the portfolio or filling up cash flow. And as we talk about cash flow, money market yields are still around 4.3% in the portfolio. So as we're holding cash for our clients for the next 6 months or so of their expenses, it continues to earn a nice yield. So we look for big market upswings to refill all of our clients' cash buckets that need that monthly distribution. And we look for good times to do that when the market is doing well. So if we do see short-term dips in the market, we don't have to sell in those periods of time, that we've already filled up the cash bucket for at least the next 6 to 8 months of distribution needs. And clients that are not taking monthly distributions, if you do have any shorter term needs coming up, I would say in the next 6 to 12 months where you do see some cash needed from the portfolio, the better heads up you can give us, it allows us to plan a little bit better of when to raise that cash. We start collecting dividends and interest payments and fill up that cash bucket so that we're not forced sellers if you need the money a week from now and a big trip or expenses come up. So the better heads up you can give us, the better we can plan and take that into account and fill up those cash needs and not be forced sellers at inopportune times throughout the market if we do expect a little bit more volatility this year overall. And with that, we just want to say, thank you for tuning in. Thank you for the trust that you've placed in us. And please reach out if there's any questions or if you want to go through any more details of the presentation. We'd be happy to answer any questions or go into more detail.
Perfect. Keith, thank you for your time and thank you for the presentation. As Keith mentioned, if there's any questions or someone just wants to go over any of the topics or how this information applies to your portfolios, please reach out. We're here for you and happy to assist. And if you're not a customer of Tower Trust and Investment Company and like what you heard, please give us a call. We'd be happy to chat with you. So have a great day, everybody, and take care. Thank you.